Jobless claims coming at 201. We're looking for 216. Previous week, 213. How much weight, Mike, are you putting on this data? Payrolls, hot. CPI, PPI, hot. ISM, decent. Claims, lower. How much weight are you putting on that?
Yeah, thanks for having me on, John. If we just focus on those, I mean, the discussion would probably rapidly shift to when is the Fed going to raise rates again, which you at least have a small minority of folks talking about. But we had some other data that was actually quite soft. Retail sales for January missed, fairly weak internals. Industrial production and manufacturing were also soft. So in the broad context, I think the data is more mixed, but no doubt about it, those Fed minutes I do think were revealing in the sense that we do see the Fed continuing to push back on both the timing and the magnitude of the easing that was expected coming into the year. And one of the things that we've been writing about is, the consensus view seemed to shift to this idea that we'd have no recession or an economic acceleration, double-digit profits growth, and 6 rate cuts anyway. And that didn't seem to make a lot of sense. Our view was you get the rate cuts if the economy really weakens. And if it doesn't, then the Fed's going to be, pushing back on those expectations. And that's what we have here with the 10-year yield now up into the 430s, the last I saw.
Mike, you said timing and magnitude. Talk to me about timing, and then we'll get to magnitude. What kind of timing are you thinking about now?
Well, it's interesting. I mean, the Fed funds futures markets, the implied yields over a 3-year horizon, I think are up about 70 basis points from the lows last year. So that's a fairly big move. That explains why the 10-year yield is rising. We're not really seeing a breakout in bond market inflation expectations here, but it looks like, the cuts now have been pushed, not just from starting in March to May, but perhaps not until this summer. And it'll really depend on the data. What Fed Chair Powell is saying is that we don't know where the neutral interest rate is. Tom likes to say the Vixillian equilibrium rate. It'll depend on how the economy performs. If the labor market is holding up, if so-called financial conditions are accommodative, then the Fed is not going to have a compelling reason to start cutting rates in any meaningful sense. And so I think it really is data dependency to an extreme for the Fed here now.